Hello and welcome back to Express videos relating to ACCA paper P2. In this Express video, we will talk about IAS 19 employee benefits, and please feel free to download our Express notes from our website at www.theexpgroup.com. Employee benefits are often examined, and therefore it's critical or crucial to understand how employee benefits are accounted for. Roughly speaking, there are two types of pension plans. One which is a defined contribution and the other one which is a defined benefit plan. A promise to actually pay a pension in the future or to make a contribution into a pension plan, it's a liability for the company that makes the promise at the year end. So IAS 19 is just an application, if you want, of IAS 37 provisions. Let's see how a defined contribution and then a defined benefit plan is accounted for. A defined contribution, these are fairly easy. So the employer is just making a promise to make a contribution on behalf of the employee to a certain pension fund. All the risk that this fund is actually inadequate to actually support the employee between retirement and death rests with the employee and therefore not with the employer. So accounting for this in the exam is fairly straightforward. It's just the application of a provision. I will just have to book an expense with the contribution promised during the accounting period, and in the statement of financial position I will actually have an asset or a liability if that promise was not actually paid or was overpaid by the year end. Contrast that with defined benefit plan, where accounting is a little bit more complicated, but once you practice one or two questions, the numbers will fall into place. They are not that easy to reflect. So in here, the scenario is like this. The employer makes a promise to make future pension payments between the retirement and the death of the employee. And therefore, in this case of scenario, the risks lies with the employer. If the pension fund does not have enough assets to pay pensions to the pensioners, then the company will have to come up with the difference to pay the payments, to pay the pensions. Impact, therefore, in the statement of financial position. In here we will have the plan assets, which are ring-fenced from the assets of the company, meaning they are not under the control of the company. They are just a separate legal entity controlled by a board of trustees. We have a pension plan liability, which is reflected at the net present value of the pension promises made by the year end and some deferred costs and income. The impact in the statement of comprehensive income will actually have three components: service, net interest component, and the remeasurement component. The service component is actually the cost of the pensions that we promise into this accounting period, which may contain the current and the past service cost, and those are actually charged to P&L. Net interest component is computed by applying the discount rate that we use to measure the plan obligation to the net defined benefit liability or asset, and this one is charged or credited directly to P&L, depending whether it relates to assets or liabilities. Remeasurement component includes the actuarial gains and losses that actually occur during the accounting period, including the return on the plan assets less any amount taken to P&L as part of the net interest component. This is going to be charged in other comprehensive income, and it will never be recycled into the profit and loss in future period. With respect with these actuarial gains and losses, the thing that I want to point out is they are not expected. It's not something that we plan for. They appear just because the actuarial assumptions that we have done in the previous accounting year change versus what actually happened during the accounting period. And therefore, assets of the plan and liabilities to pay the pensions in a perfect world will be equal, but in real life, due to differences in assumptions about the actuarial liability, those will vary from year to year. That's why we will actually report them to other comprehensive income. Key definitions are for the preparation of P2 examination is the following. Current service cost. Current service cost is the net present value of an extra pension that was promised to staff in return for work they did into the accounting period. Defined benefit plans are basically characterized by offering greater pension to people who actually worked more for the company. So one extra period of service, it will increase the liability of the company to pay future pensions. Past service cost is the net present value of extra pensions that were promised to staff during the accounting period for the work they did in the past. This is less common in practice, and it's actually applied when the company wants to eliminate some actuarial surpluses on the pension plan. Net interest component, that relates to change measurement of both the plan obligation and the plan assets, which actually arises from the passage of time and is reported as a separate component into the profit and loss account. If we look at numbers, then how to account for it will become a little bit more clear. There are three accounts, if you want, to follow: plan assets, pension liability, and what transaction will actually hit our profit and loss for the period. We will have opening balance for both plan assets and plan liabilities. Current service cost is just an increase in the liability because staff has worked one more year for us. Past service cost is an increase in the liability for the work they did in the future. Interest charge, it's part of the net interest component, and it's just an increase in the liability due to passage of time. Contributions paid into the plan are actually paid out of the company cash account, and those will actually increase the plan assets. Pensions paid to the pensioners will actually reduce the plan assets, and at the same time it will reduce the liability. Interest return is again part of the net interest component. One more year has passed and the plan assets have earned income, and therefore if we add them up, the expected carry forward figure for the plan can be easily calculated. The actual figure, which will be given to you in the exam, will help us calculate the remeasurement component, the actuarial or the gains and losses that we did not expect. And therefore on the pension liability we have a gain, but on the other hand on the pension assets we have a loss, and therefore the net interest component for the period is actually a loss. Our profit and loss account for the period, it will be charged with current service cost, past service cost, and if you want net interest component. The actuarial gains and loss will be actually reported in other comprehensive income for the year, and it will never be recycled to P&L.